What's up, everyone? Today's topic is something that can make or break your financial success: the dangers of getting too obsessed with optimization instead of actually taking action. Imagine if you could turn $1 into $11.35 trillion by year-end just by perfectly predicting the best US stock each month. Sounds amazing, right? But today, we're diving into why that obsession with perfection can actually sabotage your financial growth. This is the Finance Virtuoso channel, where we talk about all things finance. If you're new here, be sure to subscribe and hit the notification bell so you don't miss out on any future money tips and tricks. We all want to maximize our money and get the highest possible returns, right? So the temptation to try and perfectly optimize every little thing is always there. If we just spend more time analyzing and tweaking our strategy, surely we can crack the code and find that perfect optimal approach, right? But more often than not, that obsessive quest for optimization backfires and ends up sabotaging our long-term growth. We get so hyper-focused on finding the absolute best solution that we end up stuck overthinking, rather than just picking a solid plan and starting to make progress. We wrongly convince ourselves that if we just optimize our approach more and more, we'll eventually hit the jackpot. When the truth is, you're almost always better off using an investment strategy or financial plan that may be pretty good but not necessarily 100% theoretically optimized, and just executing it diligently for decades. Let me give you some key examples of where over-optimization can really mess you up and cost you a fortune. The first is with your investment portfolio's asset allocation: endlessly analyzing historical data, backtesting scenarios, projecting economic factors, all in an effort to engineer the absolute optimal mix of stocks, bonds, real estate, and so on. Sure, on paper you may find an allocation that looks amazing based on the stats and your assumptions. But there are two critical potential pitfalls here. 1. You build an ultra-aggressive portfolio citing great long-term returns, but it ends up being way too volatile for your personal risk tolerance. You inevitably panic and sell at the wrong times, locking in losses. 2. You try timing the market based on your analysis of the current economic cycle. You convince yourself we're in a new situation demanding a different asset mix. But economic cycles are incredibly hard to predict accurately, and you get burned badly when reality plays out differently. It's like that hypothetical investor who went 100% into stock investments based on the historical data. But he ended up getting wrecked because he panicked and sold all his stocks at the wrong times, during the dot-com crash of the early 2000s and then again in the 2008 financial crisis after losing his job with no rainy day fund to fall back on. A more balanced asset allocation could have prevented those progress-wrecking scenarios. The second major optimization trap is chasing individual investment opportunities that are portrayed as optimal and can't miss by talking heads, trading schemes, or your own hype biases. Maybe it's a hot stock pick, asset class, trading strategy, you name it. Greed takes over, and you go all in seeking those promised unicorn returns. Or on the flip side, you get so discouraged chasing whales that you avoid decent opportunities, stubbornly waiting for the perfect one. You can fall for scams and unproven millionaire secret systems. But you don't even need outright scams involved to make huge mistakes here. It's often just undisciplined behavior leading you to over-leverage into high-risk, high-reward plays that are blinded by theoretical upside potential. The third major optimization trap I want to highlight is the temptation to use leverage in an effort to maximize your returns. Leveraged investment products like some ETFs aim to amplify market movements. And on paper, successfully juicing your compounding through leverage can seem like the ultimate optimization hack. But leverage is a powerful double-edged sword in the real world. Leveraged funds can amazingly outperform for periods of time, only to then give it all back and more when volatility spikes hit. You get swift, violent losses that can set you back tremendously. So what's the solution? How do we avoid falling into these optimization traps that can completely derail our financial progress? The answer is, good enough is good enough. Rather than driving yourself crazy chasing that elusive, perfect optimal solution, start by figuring out a reliable, good enough plan to reach your goals. One that fits your personal situation and risk tolerance levels. For investments, that could be as straightforward as a simple portfolio split between stocks and bonds at percentages appropriate for your age and risk profile. Or just buying and holding a handful of solid, established company stocks and low-cost index funds. The key is finding a time-tested, fundamentally sound strategy that lets you steadily grow your wealth over decades, without having to be a gunslinging trader or speculator. Establish that good enough baseline plan first. Only once you have that primary investment engine running steadily should you even consider allocating a small percentage of your capital to higher risk/higher reward optimization plays, like trying to time economic cycles or betting on individual securities. But treat those opportunistic optimizations as just potential upside bonuses, not the core driver. Limit it to a small amount you can truly afford to lose without messing up your overall progress. Because at the end of the day, real sustained wealth is rarely built through finding a magical optimal strategy. It comes from disciplined, uninterrupted compounding over many years through a reasonable, personal plan. You're probably never going to pull off that $1 to $11 trillion miracle. But consistently growing your net worth into the millions or more through a sustainable good enough approach is still an incredible success. Don't let the tempting siren song of chasing optimal results at all costs cause you to sabotage really great outcomes. That path is filled with excessive trading, speculating beyond your limits, getting over-leveraged and inevitably blown up. Instead, embrace a defensive approach first. Lock in a solid financial foundation and upward trajectory using fundamentally sensible strategies. Let that primary engine steadily work year after year, mostly tuning out the shiny, distracting optimization noise. Then if you want, you can allocate a small fund to trying out higher conviction market plays or personal optimization theses. But only within reasonable limits once your base is covered and secure. Never, ever risk derailing your good enough core plan that's pulling you forward in pursuit of those bigger scores. Protect that bedrock asset base at all costs. At the end of the day, self-awareness about your personal optimization tendencies and triggers is key. If you notice yourself falling into these traps, whether it's overtrading, paralysis from trying to optimize your budget perfectly, or constantly jumping jobs searching for the absolute ideal career, hit pause. Reevaluate if that optimization obsession is actually benefiting you, or just feeding unproductive behaviors. Find your own fundamentally sound good enough system first, commit to executing it relentlessly, and keep any upside optimization plays separate. That steady, disciplined approach may not feel as sexy as chasing infinite optimization. But it's what actually drives long-standing, life-changing wealth accumulation more often than not. Alright everyone, that's going to wrap up today's discussion on avoiding the pitfalls of over-optimization with your finances. Let me know your thoughts down in the comments. If this perspective resonated with you, smash that like button before you go and make sure you're subscribed too so you catch all my uploads. Thanks for watching, and until next time, keep building your wealth sustainably by sticking to good enough systems rather than chasing optimization rabbits. Trust the process, let compounding work its magic over time, and you can absolutely achieve amazing results.